IFRS 19 Subsidiaries without public accountability. Disclosures was developed to simplify financial reporting requirements for eligible subsidiaries while maintaining consistency with IFRS accounting standards. Many subsidiaries operate within larger corporate groups and prepare separate financial statements primarily for local regulatory purposes, lenders, or internal stakeholders rather than public investors. Applying full IFRS disclosure requirements to such subsidiaries can create unnecessary complexity and administrative burden. IFRS 19 therefore allows qualifying subsidiaries to apply reduced disclosure requirements while continuing to use full IFRS recognition and measurement principles. This approach improves efficiency and cost-effectiveness without compromising the reliability or comparability of financial information. The standard supports streamlined reporting while ensuring that essential financial information remains transparent and useful to users of separate financial statements. A subsidiary may apply the reduced disclosure requirements under IFRS 19 only if it does not have public accountability. Public accountability generally exists when an entity's debt or equity instruments are traded in public markets or when the entity holds assets in a fiduciary capacity for a broad group of external parties, such as banks, insurance companies, or investment funds. Subsidiaries without these characteristics are considered to have lower public reporting obligations and may therefore qualify for disclosure relief. In addition, the subsidiary's parent must prepare publicly available consolidated financial statements complying with IFRS accounting standards. These conditions ensure that stakeholders still have access to comprehensive group-level information even though subsidiary disclosures are simplified within separate financial statements. The reduced disclosure framework under IFRS 19 affects presentation and disclosure requirements rather than recognition and measurement principles. Eligible subsidiaries continue applying the same accounting treatments required under full IFRS accounting standards for assets, liabilities, revenues, expenses, and transactions. However, they may omit or simplify certain note disclosures considered more relevant for publicly accountable entities. Examples may include detailed financial instrument disclosures, extensive fair value hierarchy information, or highly detailed risk management disclosures. This distinction is important because it preserves consistency between separate and consolidated financial reporting while reducing unnecessary reporting burdens. As a result, financial statements remain reliable and IFRS compliant even though disclosure requirements are less extensive than full IFRS standards. The rationale behind IFRS 19 is based on balancing cost and benefit considerations in financial reporting. Preparing extensive disclosures can be costly and time-consuming for subsidiaries with relatively simple operations or limited external reporting users. Many disclosure requirements in full IFRS are designed primarily for investors in public capital markets rather than private stakeholders. IFRS 19 recognizes that users of subsidiary financial statements often rely heavily on the parent entity's consolidated financial statements for broader financial information. Reduced disclosures therefore allow subsidiaries to focus on information most relevant to local users while still maintaining high-quality accounting standards. This approach enhances reporting efficiency without reducing the overall integrity of financial reporting within multinational corporate groups. Despite reduced disclosure requirements, subsidiaries applying IFRS 19 must still provide sufficient information to achieve fair presentation and faithful representation of their financial statements. Material accounting policies, significant judgments, related party transactions, and key financial information may still require disclosure depending on circumstances. Entities must also comply with any additional local legal or regulatory reporting obligations applicable in their jurisdictions. Professional judgment remains important in determining whether additional disclosures are necessary to help users understand the subsidiary's financial performance, position, and risks adequately. IFRS 19 therefore simplifies disclosure requirements without eliminating transparency or reducing accountability within financial reporting practices governed by IFRS accounting standards. Overall, IFRS 19 provides a practical and efficient reporting solution for subsidiaries without public accountability operating within larger corporate groups. By allowing reduced disclosures while retaining full IFRS recognition and measurement principles, the standard balances transparency, comparability, and cost-effectiveness in financial reporting. Eligible subsidiaries benefit from simplified compliance obligations, reduced preparation costs, and improved operational efficiency while stakeholders continue receiving reliable and relevant financial information. The framework also supports consistency between separate and consolidated financial statements, strengthening the quality of group reporting. For DipFRS candidates, Understanding IFRS 19 is important because many multinational organizations include subsidiaries qualifying for reduced disclosure treatment under international financial reporting requirements.